Alrighty, welcome everybody to another episode of Paladin Financial Talk. I'm your host, Jack Eckholm, and joined here today by my colleague and fellow advisor, Jeff Foley. Jeff, how are you today?
Good. How about you?
Doing well.
Good.
Excited for our conversation. I'm sure you can relate, Jeff. Many of us have been really busy this past year, and it's really easy to lose track of time with our busy routines. But you know who's been paying close attention to the calendar?
Santa Claus.
Him too, but also the IRS. So as we close the door on the 2025 tax year and enter into this 3.5-month home stretch leading up to the tax return deadline on April 15th, it's important to start crafting and implementing a plan for you and your family to get your taxes not only done on time, but also as efficiently as possible by being proactive and taking advantage of all the opportunities that might be out there for you to lower your lifetime tax bill. And that is what we are excited to be discussing today.
Always excited to talk about taxes, Jack.
I love it. So for most people, Jeff, taxes might be nothing more than gathering documents, handing them to their tax preparer at tax time, and then paying what they're told they owe. So are there some ways people can sort of reframe that and get in place a solid tax plan to follow, not just in 1 year, but over the course of many years?
Yeah, absolutely. A lot of people look at taxes as something that happens to them. And to a degree, that is the case. The rules are the rules. But if we're proactive, we can create our own plan, create our own history, write our own history over time with taxes. So not just sitting back and letting that happen to us. So being proactive is a big piece of this, and having a solid tax plan. Also, one of our go-to phrases at Paladin and talking with clients is a low tax year is a terrible thing to waste. What I mean by that is a lot of people will be very excited about, hey, I didn't pay much in taxes this year and I'm getting a refund, and they think that's a win. And that's not necessarily the case. Just because you're not paying much in taxes doesn't mean that you're not going to pay more in taxes later. So if you believe tax rates are going up over time, it might make sense to pay more in taxes now and have more tax-free income later, as an example. You also want to make sure that you're coordinating your tax plan and your financial plan. So at Paladin, we talk about the 4 pillars. You have your financial plan, your health plan, your tax plan, and your estate plan. So your tax and financial plan in particular need to talk together quite a bit. So we'll talk about some of the ways in which that is the case, but make sure those are coordinated and well thought out. And number 4 is understand what's changed. The IRS, to the tax law is always written in pencil, and there are always changes occurring. And we had a big one this year with the One Big Beautiful Bill Act, or OBBBAA, is another way of saying that. Just rolls off the tongue. So understand what's changed from year to year, and planning ahead a little bit too, to know, hey, this maybe next year isn't as advantageous. So is there a way I could pull income into the current tax year, as an example? So that ties in with being proactive.
Mm-hmm. It's a good way to reframe that, not thinking just about this year's tax bill, but again, back to that lifetime tax bill. How do I minimize that? And like you said, that might mean actually paying more this year, bringing more income into this year, tactically to do that.
Yeah. So, taxes, it's a marathon, not a sprint.
That's a good way to put it. And Jeff, you're known for being big on processes and procedures, and that's kind of the mindset that we operate under at Paladin to make sure we don't leave any stones unturned for our clients. Do you have any recommendations for sort of a tax process that people can follow here in tax time to ensure a smooth tax season and make sure things are done correctly for them?
Yeah, absolutely. And that goes back to being proactive. Is what is your process? So literally sit down and lay out, here are the things that I need to do and gather and communicate, and deadlines, and think through that. And then going forward year to year, you can use that as your checklist to make sure you've covered everything. So one of the ways that I've used in our taxes, and have a number of clients do this as well, you've got a tax folder or a tax drawer. I actually have a drawer with a folder in it, and throughout the year, as donations and different things occur, I'm putting those things in that drawer. So when it comes to tax time, I've got everything in one place, and I know where to look for that. So how are you receiving tax notices is another big thing. So for example, 1099s, are you getting those all electronically, all through the mail? Understand what you're doing for each of those. So that'd be something you could put into your process. If you know you're going to get 4 1099s, for example, write down on your process where those are coming to. They're coming to my email address or they're coming in the mail. Personally, I prefer if I can get those through the mail, just so it's pushed in front of me, because I need to provide that to my CPA in the preparation process anyway. So that's a big one. So gathering your 1099s, if you did a rollover, if you did a qualified charitable distribution during the year, there is a change for this year that the IRS has finally put a spot on the 1099 to indicate that a QCD has taken place. So qualified charitable distribution, once you're age 70 and a half, you have the ability to take money out of your IRA, give that directly to a charity, and that reduces your taxable income. Or not, doesn't reduce your taxable income. It's a non-taxable event. And if you're of RMD age, that will count towards your required minimum distribution. So there is a new code on the 1099-R. It's a code Y, and that indicates that a QCD did take place starting in 2025. So that's a good one. So those are a few. Roth conversions, another one to note. Did I do any Roth conversions? How much? Review your Social Security statement if you're still employed. So what I would recommend, if you're still working, print off, log into Social Security and download a recent Social Security statement, print that off, put that in your tax folder. And each year, as you prepare for that tax season, log into Social Security and make sure that your employer reported your earnings correctly, because that's what's going to determine your future Social Security income. And if you're 45 years old and you're not taking Social Security for another 20 years, you're not going to remember what you earned in 2025. So look at it while that's pretty recent.
That's a great point.
So yeah, gather receipts, keep track of your deductions, but overall having a good process for that.
Great points. And going back to the 1099 conversation too, a couple things to check there that we see issues with our clients pretty commonly. One, it's possible on your 1099s, if you made a non-taxable transaction, so like a rollover, for example, it's possible it might be incorrectly coded as taxable on your 1099. So check those documents to make sure that's correct. And if it's incorrect, it's on you to communicate to your tax preparer, hey, this is incorrect. This is what happened. This is how it should be represented on my return. So look out for those things. Another thing is, if you sold stock or other assets in a taxable account during the year, make sure that the realized gains reflected on your 1099 look correct. An issue we've seen pretty commonly is, especially if you have stock that you purchased decades ago and that's moved from many different custodians, it's possible the current custodian at which you sold it this year, they have an incorrect basis amount or a completely missing basis amount, which means they're saying the entire amount of what you sold is taxable, which may or may not be correct. So look into those things. And if something's wrong, again, work with your tax preparer, or sometimes you have to work directly with the custodian to get that 1099 fixed.
That's a good point. We should actually do an episode just on that topic and how do you handle that. So that's a good one.
So another thing, Jeff, as we enter 2026, we begin planning for another tax year. One big factor in your tax picture and an important decision to make is, where should I be saving and contributing account-wise, and how much should I be? So how should people be thinking about and maybe reevaluating the contributions that they're making here during tax time?
Yeah. So to answer that, you have to understand your overall financial picture. So zooming out and looking at how much do you have in savings? Do you have a appropriately stocked emergency fund? If something comes up, you might be socking away $20,000, $30,000 a year into retirement assets. But if your car needs repaired, you don't want to have to put money on your credit card. So you have to have a balance between all these pieces. So looking at what you have in debt and savings, what interest rates are you paying on the debt? If you have a mortgage where you're paying 2.5%, you timed it just right during COVID and refinanced. Personally, I would generally not be too aggressive in trying to pay that off. But if you have credit card debt where you're paying 15, 20%, I would worry about getting that taken care of before trying to increase your retirement plan contributions. But you also have to look at things like your employer match. You know, if you have a very favorable employer match, that should be considered in that process as well. You also want to identify your mixture of pre-tax and Roth contributions. A lot of people started their working career prior to Roth existing in the mid 90s, and everything's been on autopilot. You put it in on a pre-tax basis, but going back to our conversation earlier, it might make sense to get some of those taxes out of the way now and have some of your money funded on a Roth basis or a mixture of that. And that can change from year to year as well. And if you have retirement plans at work, in addition to that, you have your IRAs that you might be able to contribute to. So you understand that overall balance and what that's going to do to your tax plan and your retirement plan long term.
Mhm. And so, especially for people that are getting closer to retirement, they might have an opportunity to contribute more than they previously could through catch-up contributions. Which ones should people be looking out for there?
Yeah. A big one that once you turn age 50, and it's actually the calendar year that you turn age 50, you can put in more money into a traditional IRA. In 2025, that's an additional $1,000. So you can put 7,000 plus 1,000, a total of 8. In 2026, that's going to bump up a little bit to 7,500 is the traditional contribution, and another $1,100 catch up for a total of 8,600. But for 2025, be aware of that age 50 catch up. So that can have some additional tax savings if that makes sense in your situation. Now, defined contribution plans, the regular contribution limit. So, for example, like a 401k, that traditional contribution limit is 23,500, but once you're age 50, you can do an additional 7,500. So that's a total of 31,000. And then you also have what's called the super catch up that applies to ages 60 through 63. And that's 11,250 is the catch up instead of 7,500. So that all can add up quite a bit, particularly if you have a married couple and you're doubling that amount. That's a lot of money that you could put away for retirement. With HSAs, you have $1,000 catch up starting at age 55. So that one's a little bit different.
And you mentioned it there. An important thing to remember, those are based on your age at the end of the year. So let's say you're 49 now, you're going into 2026 and thinking about potentially making a catch-up contribution, you would be eligible in 2026. Yes, you're 49 now, but at the end of the tax year, you'll be 50 and thus eligible for those. And it can also work the other way, on the contrary, for that super catch-up. If you are 63 now, but you're turning 64 in 2026, you wouldn't be eligible for that additional amount. So make sure to make that distinction. Another thing to mention here is, what are the deadlines for these contributions? So the 401ks, 403bs, HSAs, those employer plans, those are on a calendar year basis generally. So if you're listening to this in 2026, wanting to make more contributions for 2025 to your 401k, for example, unfortunately, it's too late. But for IRAs and Roth IRAs, those are on the deadline, rather, is the tax deadline without extension. So you still have time, if you haven't made contributions or haven't maxed out your contributions, to make more contributions up until that April 15th deadline. And then note there, if you end up extending your taxes, that doesn't extend your deadline. So it's still April 15th. So be aware of that.
Yeah.
So kind of transitioning to something else, Jeff, being self-employed for our business owners out there, and running one's own business opens the door to a lot of business related expenses that may be deductible from business income. So as a business owner yourself, are there things that business owners might be spending on that they might be missing deductions for?
Yeah, absolutely. Random movie reference. If you've seen the movie The Accountant, have you seen that?
I have not seen it.
Okay. So if you've seen that, you know the movie reference there where he's helping a couple out with their taxes. So you want to be aware of what expenses you're incurring. And some people get a little bit too aggressive with this, and they're writing off way too many things. If they ever get audited, they're not going to be able to substantiate those expenses. But if you have a home office, for example, and you look at your square footage, let's say you've got a 3,000 square foot home and 10% of that is allocated to your home office, and it's a dedicated home office. You don't have toys and other things in there, that you could generally deduct 10% of the expenses associated with the household. So for example, internet, phone bills, utilities, etc. Because if you were renting a space and had an actual office space outside of the home, you're going to incur those types of expenses, is the logic. So keep track of that, but you have to have a good record. So going back to the process, for example, you could have a spreadsheet that you go back and you look at the end of the year. How much was your utility bill, your phone bill, the internet bill, et cetera? Add those up for the year. And then whatever percent you're allocating to the home business, you get to take a percentage of that based on that square footage. Vehicle usage, you can either do the mileage rate or actual expenses. You get to choose between those, whichever is more advantageous. Education expenses, if you have expenses related to maintaining your profession. So for example, with what we do, I don't know, do probably 40 hours a year of CE. Any expenses related to that are deductible and to maintain or improve your business. Now, if you're looking at changing careers and you want to go to Votech or something to get an additional some learning, that is not deductible if you're changing careers, but maintaining is. So understand what expenses are incurred, cell phones. There's a lot that can go into that.
That's great. You mentioned at the beginning of our episode as well, paying attention to what's changed since last tax season. We actually had quite a landmark piece of tax legislation this year in July in the form of the One Big Beautiful Bill Act. Now, the main thing the bill did was made permanent, and I say permanent in quotes, really, the current tax rates that were cut back in 2017 by the Tax Cuts and Jobs Act, and they were set to revert to higher levels in 2026, but the bill is keeping them permanent for now. Although, another piece of legislation could change that in the future.
Temporarily permanent.
Yes. As you like to say, the tax law is written in pencil. So be aware of that. So another thing the bill did, in addition to the tax bracket changes, or keeping them the same really, was introduced a number of new deductions that people can take advantage of. And these are unique. Tax professionals are calling them above the line, below the line deductions. Above the line in the sense that you don't have to itemize to get them, but below the line in the sense that they don't reduce your adjusted gross income. And that's the figure that's used for a lot of phase out ranges, things like Roth IRA contributions, IRMA surcharges. What should people know about these deductions?
Yeah, and if you are listening to the podcast for the first time, you want to go back and look. We've done more detail about the One Big Beautiful Bill this year and some of those changes, but a couple highlights here to be aware of is tip income up to $25,000, and the IRS has a specific listing of typical jobs that are appropriate to use for that. Like an accountant typically doesn't get tipped, so you can't write that off. So up to 25,000 there. Overtime pay $12,500 per person, 25,000 if you're married. And the idea is that overtime pay, it's only the overtime portion. So if you're getting paid time and a half, it's the half that you're able to reduce your income with that. And you have phase outs on those two. That begins between 150 to 200,000 of income if you're single, and 300 to 400,000 if you're married filing jointly, and that's based on modified adjusted gross income. You also have car loan interest. So if you're buying a brand new car made in the US, very specific rules around this, that you can deduct up to $10,000 of interest from that. You have phase outs using modified adjusted gross income. Of course, they can't all be the same, but 100,000 or 200,000 if you're joint. And a big one for a lot of people this year, this has helped people either save money in taxes this year or created more room for Roth conversions or realizing gains on taxable accounts, is the new enhanced senior deduction that starts beginning at age 65. Each person gets $6,000 of enhanced senior deduction, and you get phased out of that as your income increases. And that's 75 to 175,000 income if you're single, and married is 150 to 250. So those are four of the biggest ones to be aware of that are changes you can take advantage of now.
Those are great. Lots of potential savings there. On the overtime piece, just to make people aware, if that's applicable, if you have overtime pay in what you do, make sure to keep documentation this year of the amount of your pay that you can attribute to the overtime. The IRS has basically said for this year, hey, employers, it's on you to keep track of that and report it to your employees. And they haven't provided much guidance on how that should be done, at least for this year. So it might end up being on you to calculate that and make that delineation for tax reporting purposes. So be aware of that. And we mentioned earlier, Jeff, that lifetime tax bill that we help clients minimize. So whether it's for 2025 or for another year, are there any actionable strategies that people can actually employ to help do that, to minimize that lifetime bill?
Yeah. Track everything. So the IRS isn't interested in what you think happened. They want you to be able to prove what happened. So the tips, the overtime income, charitable deductions, be able to back all of that up with receipts and documentation. Look at bunching deductions. So, for example, if you give to the church, let's say $2,000 a year, and it might make sense to bunch those deductions and take, do 2 years worth of contributions in 1 year, skip next year, and that might help you to save more in taxes depending on your situation. You might also look at accelerating income. So maybe pulling income into this year versus next year, where you have more control on this if you're a business owner. Or same thing with expenses. Should I pull those expenses into this year? Hey, I was planning on, buying XYZ next year. Maybe I do that before the end of the year. Because of this year's income being higher. Also evaluate Roth conversions. We do hundreds of Roth conversions a year for our clients, and there's a lot of opportunity there, different nuances with Roth conversions you want to be aware of. And then review your 2024 tax return. So as you prepare for 2025, look back at your 2024 return and make sure, and what line items did I have, and make sure that I have documentation for 2025 that's applicable. So for example, if you had interest and dividend income from a brokerage account in 2024 that hit your tax return, if you still have that account, you should be on the lookout for that again in 2025. So compare your year to year to make sure you haven't overlooked something. A very common example of this that does get overlooked is the IRS 8606 form. So if you've ever done a backdoor Roth IRA contribution, that is a form that the first time you do that, forever after, you have to keep rolling that forward, and you're always going to have that 8606 form, even if you only did it one time 15 years ago. That's an example of comparing your return year to year to make sure you're not overlooking anything.
That's great. And going back to the accelerating income here into the 2025 and through 2028, with the changes that the One Big Beautiful Bill Act made, keeping our current low tax brackets in place and adding in all these deductions, we're in a relatively low tax environment, especially historically. So lots of opportunity there to tactically place income here in the next few years to potentially, again, lower your bill in the future.
I like that, tactically place income.
Yeah.
I like that.
So lots of great food for thought from our discussion here today, Jeff, but also a lot of complexity. So for people who may be overwhelmed by everything we've discussed and just the tax process in general, what can Paladin do to help, and how would people get in touch with us for that?
Yeah. So the IRS doesn't make things simple, and that got more complicated with the bill that we've been talking about today. So that complexity actually can create opportunities if you think through your plan and you understand the nuances of the tax code and how that works. That's something we enjoy doing here at Paladin. So more moving parts means potentially more opportunity for you. We want to make this year your most tax efficient year yet. And I say tax efficient, not tax savings. As we talked about, saving money in taxes now doesn't mean that you're saving money long term, but be smart about what you're doing, be proactive. If you're interested, we also offer Paladin tax services. So we do tax preparation as well. And if you're interested in learning more about Paladin tax services, email us at info@paladinfinancial.com and just say, I'm interested in Paladin tax services. We can reach out to you with some additional information about that. We also have a piece that we'd like to provide to you called our 12-point tax return checklist. So this is a tool that if you're doing your own taxes, in particular, you can use that to walk through and identify, are there any opportunities to save money, avoid errors on your tax return? If you're interested in that, email us at info@paladinfinancial.com, and we'd be glad to send that out to you. And you can also visit our website, paladinfinancial.com, and click on our services and then tax strategies to learn more about Paladin tax services there as well.
Awesome. Well, thanks, Jeff, for another great episode. To kind of recap things for our listeners, today we touched on having a tax plan, and that's something we help our clients with at Paladin. So evaluating not just this year, but over the course of many years, different strategies like bunching your charitable deductions or implementing Roth conversions, taking advantage of our currently low tax environment and thinking beyond just 2025 or 2026. And then here in tax time, figuring out your tax process and following that to make sure things are done accurately and efficiently for you this year. And then we also talked about account contributions and deductions that might be available to you, reevaluating those here as we approach tax time. including the opportunities from the One Big Beautiful Bill Act, the number of deductions that we talked about. And if you're confused or want help, again, email us at info@paladinfinancial.com. That's INFO at paladinfinancial.com. Paladin's tax services can help you prepare your tax return. We also have that tax return checklist to provide to you as well if you're interested. And as always, if you have questions or want help with not just taxes, but also your financial, your health, and or your estate plans, give us a call. Our number is 651-842-8406. So this has been another episode of Paladin Financial Talk. And from all of us here at Paladin, have a great week and have a happy holidays.